SOFI stock is getting smoked after the company announced their Q4 earnings. Shares are down by about 11%. This is recorded during the regular trade. We do have some deep seek spillover probably into a name like this, as the meme gods and the millennials out there and maybe Gen Z or whoever's buying this stock have really pumped it up. And we'll talk about that. This is your like a typical bank stock, and the valuation has absolutely gone to levels that you don't see. Talk about a couple of things when we get over to the financials. There is one thing that I do want to point out from kind of an earnings perspective. On paper, the EPS and all those types of things will look good, but when you start to strip out like a very specific thing with SOFI, actually the current quarter is not that great. We also have to factor in the company gave us Q1 guidance as well. Came underneath the expectations, at least from an earnings perspective, but revenue also very, very strong. We'll also look at this one technically. It was setting up for a technical sell. I didn't make this graphic before I recorded the video. In fact, I made it yesterday. Technicals were a sell. Valuation on this one was absolutely a sell. I'll show that to you here in a minute. Growth rate is still really good, and so we'll talk about that. That's one of the reasons why it probably has a premium multiple, but another reason why is you go on YouTube and you go on Twitter and you go around to these kind of younger investors out there. For whatever reason, they've piled into SOFI. They think this is going to be the next great stock. And for some companies, I can understand that. A Palantir, they actually do something interesting. This is literally just a financial institution. Doesn't do anything differently than what a JP Morgan, a Wells Fargo, or a Bank of America is doing. But for some reason, this one's been pumped up to 4 times tangible book. So long way of saying is you're probably going to get some buying opportunities much, much, much lower on this one. And it goes without saying, over the past year, you're up 110% on this one. And obviously some of it is warranted based on the fact that you have a 19% growth rate on this one. Not a lot of bank stocks are growing at 19%. Revenues came in at 734. It beat expectations by a lot. They tend to set a low bar over at SOFI. They tend to beat on that revenue side. They know how the game is played on Wall Street. They like to set a low bar and come over it. Now, we got Q1 guidance as well. Disappointing on the EPS side. The consensus was for 6 cents, and they're coming in at 3 cents. That is going to whack your stock, 9 times out of 10. Their revenue expected to be between $725 million up to $745. The expectations on Wall Street was for $707. So really strong revenue growth. That gives us hope as we look into later this year, the springtime, summertime, fall, as we get to $750, maybe $800 million by the end of the year. Pretty confident that's probably going to happen over at SOFI based on these Q1 guidance that the company gave. So you've got kind of low 20s, mid 20s guidance or growth rate for the next several quarters. As you move into next year, that's where the challenge comes with SOFI. How do you expand this out even more? Again, we're talking about a company with a big multiple. If it didn't have a big multiple, I would be saying, wow, 15, 19, 18% growth rate as we move into next year. That is absolutely fantastic, but it's not going to do the job when your bank is worth over 4 times tangible book, which means if you were to liquidate the assets over at SOFI, the price you are paying for those assets is by a factor of 4. To give you a comparison, like a JP Morgan has a really pumped up valuation right now. Shares have been doing great with the interest rate hikes and all those types of things, and consumers still having jobs. And so you're having a nice spread on deposits versus the income that they're able to generate. Even JP Morgan, the world's biggest bank, 2.7 times tangible book. Wells Fargo, slightly different situation. They've got some regulatory issues that they're still working through. They're trading at just 1.88 times tangible book. And then you have Bank of America. They've got a big unrealized losses on their commercial real estate and other books of business that they have. They're trading at just 1.74 times. Now, I understand SOFI's books are a little cleaner than probably certainly of a Bank of America. They don't have regulatory issues like Wells Fargo, and JPM is just a rather mature banks. But all of these other stocks are paying you a dividend and buying back the shares. As it relates to SOFI, you actually don't get any of that. And so you don't get the benefits of holding the stock for the long term. And so what am I saying is you need the shares to go up, and you need to eventually sell the shares to actually make any money. On top of that, the company continues to dilute shareholders, as that is the method in which they're compensating executives. Now, all that aside, the company's done a fantastic job growing savings deposits. I remember doing earnings videos on this company before it had the bank charter. So they've done a very nice job. Now, they've done it through marketing. They've done it through, improving the tech. I'm not saying that SoFi app and the tech isn't better than certainly a Wells Fargo or Bank of America, but all of that comes at a cost. Now, they've done a nice job just growing savings deposits. They're still paying a high yield on that. So they're attracting it through high yield. So you have to wonder, as yields start to slip, the spread in which this company is going to be able to operate, that might end up compressing as well, as they're paying about 4.25 on those savings deposits. Do those run away in a lower interest rate environment? Now, because they're paying 4.25 on the savings deposits, they have to have a 9-10% kind of adjusted yield when they turn around and lend that money out. So when you look at a SoFi, they have a higher concentration in what I consider slightly higher risk loans. You have personal loans, okay? Those were up 63% over the past year on a quarterly basis. That's fantastic. 28% on a yearly basis. They're in this student loan business, which is a good business, okay? That was up 71%. You're starting to see a recovery there, up 44% year over year. Now, they're still making headways in home loans as well. You get a drop in home prices, certainly a drop in interest rates that will help that business, but it's very competitive, as we know. 87% growth there, but it's a very vast minority of their business from a revenue standpoint. Those are secured loans, okay? Home loans, if the people stop paying, well, you can go back and theoretically kick them out and sell the home. Student loans are not recoverable. They're not pledged by anything, and also personal loans. And so if you get a downtick in the economy, well, these personal loans, these student loans tend to have higher default rates. Now, they do come with higher interest rates, but the company's cost of capital is also higher because in order to attract deposits, they're paying one of the highest interest rates on a savings account. Now, I do want to point something out as it relates to the financials. They are absolutely fantastic, okay? Your total interest income coming in at 743, your interest expense just 273. So if you want to look at this like a gross margin perspective, it's fantastic, okay? $470 million of net interest income. Now, they have other fees, okay, and other ways to make money. Your total non-interest income there came in at 263. Year over year, you're seeing decent growth there. Okay, your net interest income went from 389 million up to 470. Solid growth. These are questions you have to ask yourself as an investor. Okay, the company's growing at 20 some odd percent. We got to factor in, they're going to lap those from kind of a comp perspective as we move into next year. You're going to probably slip down into kind of the mid-teens, high teens growth rate. And will it translate to much higher net interest income? It's already kind of showing a little bit of cracks there. Non-interest income went from 225 up to 263. It's not a big jump, actually, year over year. Now, what I did notice is provisions for credit losses. This is money that SoFi is setting aside just in case you don't pay your student loan or your personal loan, or even your home loan. I noticed those flattened out in the quarter. So they obviously, based on their loan mix, based on the stuff that they're seeing in the environment, they're not setting aside more. So that is good news for SoFi. If those trends continue to play out, that is good. Less provisions for credit losses impact our net income. But I'm going to show you the thing that impacted the company's net income the most is actually this income tax benefit to the tune of $272 million. So if you look year over year, your net income at SoFi on a quarterly basis, it skyrocketed from $48 million all the way up to $332 million. So on paper, you see a 4-cent earnings per share last year, all the way up to 31%, fully diluted 29 cents, up from 2 cents. And so that looks absolutely fantastic on paper, but just understand that almost all of this, and look, we all love income tax benefit, but it does nothing to project forward for SoFi. You got to assume these income tax benefits are probably not going to reoccur for a long period of time. In fact, last year they had to pay some income taxes. So you strip this 272 out of this 332 total, and you actually get to a number that's pretty close to last year, at least on an EPS and a net income perspective. So despite the stronger revenue growth, 20% year over year, beating expectations, minus a income tax benefit that the company received, you actually didn't see a lot of it trickle down to net income. Has you wondering if this company can survive a downtick in rates and maybe an uptick in defaults and credit provisions? Because remember, as interest rates go down, they are doing that because the economy is suffering and employment is suffering. If employment is suffering, it's going to be tough for those student loans to get repaid. It's going to be even harder for those personal loans to get repaid. That is why sometimes the mix of higher net worth individuals, higher net worth loan book is sometimes beneficial. Now, from a technical perspective, I had this one as a sell. Depends on what technical charts you're looking at. In fact, I looked at a few of the indicators. Some people even had this one as a buy. I had this one as a sell. That is because I tend to set things up in these channels. You had a high, higher high, higher high. You just made a new higher high on this one. So it still means SoFi is in an uptrend, but you tend to get rejected at these levels. First area of support should be down here about $14. That has served as kind of support resistance. It's not firm, but you should get an area down here in the $14, $15 range. I mean, we're only $1 away with SoFi. So that's the first area where it's interesting. Further pullbacks in SoFi, and I would actually be a buyer of this one. I wouldn't necessarily be a buyer of the underlying equity. I have traded SoFi options in the past because you have a relatively cheap stop price, you've got high volume, and you've got high retail interest in this one as well. And so that tends to set up, in my opinion, for options trades. I don't have one of these like multi-million-dollar accounts, and so lower stock price, higher volatility, that's music to your ears, kind of a mid-tier brokerage account. So further pullbacks in SoFi back into kind of the $10, $11 range. I think there'll be some setups from a trade perspective. We'll certainly alert those when those come available. Folks, that was SoFi, down about 10% after reporting those earnings. Q1 doesn't look great from an earnings perspective. And when you dig into the details, the company's quarter was benefited by an income tax benefit, and I would assume that's probably not going to reoccur as you move into later this year. And so all this growth isn't really trickling down to higher profits. The company's going to have to figure out another way to grow, and maybe they'll be able to figure out. But my guess is they'll turn into an ordinary bank stock and start trading at valuations that the other ordinary bank stocks trade at. Hopefully you enjoyed today's video. We'll be back again with more. Good luck with your investments.